This is Al Brooks. Thank you for watching the Brooks Trading course. This is the fourth of 5 videos on wedges. I want to start by talking about parabolic wedges. A parabolic curve is one that increases in its slope as it progresses. It's a type of a buy climax if it's a bull wedge. It's a type of a sell climax if it's a bear wedge. Also, strong trends always have bad-looking wedge reversal patterns. When I talk about a parabolic wedge, the wedge often does not have much of a wedge shape, but it does have 3 pushes. It's 3 consecutive buy climaxes. Here is the first push. You can say it's this 1 bar or these 3 bars, and then this second bar, and then that third bar. First push up, second push, third push. 3 pushes, so it's a wedge. Very tight channel. When it's a tight channel like that, I usually refer to it as a parabolic wedge. If it occurs at the start of a session, it's more likely to lead to a reversal. The third push here, subdivided. We had a first push, and then a pullback, and then a second push, and then a pullback, and then a third small push, and then a reversal down. You can call it a nested parabolic wedge. You can see the tail on the top of this bar, on the top of this bar, on the top of this bar, and here as well. Every time the market's going up, instead of finding new buyers, it's finding sellers. There are often gaps. The legs don't overlap. Second push up, the pullback from the second leg did not overlap the top of the first leg. There's a gap. The channel is very tight. I'm drawing an approximate channel here, but it's a very tight channel. On the way down, the same thing. A first push down, a pause, a second push down, a pause, and then a third push down, so 3 pushes down. I would call this a parabolic wedge bottom, and we got a reversal from it. The curve may or may not be parabolic. For example, this bull parabolic wedge is not parabolic. However, the bear parabolic wedge, if you draw a line connecting point 1 and point 2, and then another line connecting point 2 and point 3, the second line is steeper. So the downward slope is increasing, and that's why I use the term parabolic. You can see point 1, point 2 here, or point 2 here, and then the third push, it's steeper. Third push often breaks below the bottom of the channel before reversing. I could have drawn the line here connecting point 1, point 2, point 3, and the third breakout fell below the bottom of the channel and then reversed. That's another way to document how it's parabolic, how it's increasing its velocity downward. Anytime you have a parabolic wedge or parabolic series of buy climaxes here, 1, 2, 3, or sell climaxes, 1, 2, 3, you have to be thinking that the market has gone too far too fast. The stop is too far away. Traders have to take profits. Aggressive traders will sell a bull parabolic wedge or buy a reversal up from a bear parabolic wedge, betting on at least a small profit. Most traders should be very cautious and hesitant about taking these trades, and only take them if you can manage them well. For example, if you're selling below this bar, or better, below this bar, you want to make sure that you can rely on a stop up here, and you can sit through attempts at trend resumption here and here. If you take the first entry, entering here, your stop is up here, the risk is small, but so is the probability. If you wait until there's a strong breakout, a pair of consecutive bear bars, you have a higher probability of at least a small profit. But if you take this short, your stop is here, or maybe even here, so you're risking more. And the same is true here. If you buy the first entry above this bar, your stop is right below, your probability is not all that high. If you wait until there's a breakout and follow through, and then buy a close, the probability of making a profit is higher, but your stop is further away, either here, here, or here. And that's always the trade-off. If you wait and take the higher probability entry, you pay for it with worse risk-reward. The stop is further away, so you're risking more, and you're entering late, so there's less reward remaining in the trend. However, the math is good both for the early entry with lower probability, better risk-reward, and the later entry with greater risk, less reward, and higher probability of making profit. A parabolic wedge is a channel. We have a first push up, a deep pullback, a very strong second leg up to this high, and then a third push up there. If you want, you can call it a second leg trap in a possible trading range. First leg pullback, second leg, which it is, it's both. The second leg had 3 very big bull bars, and the tail on top represents the end of the second leg, and then we pulled back to the low of this bar and started the third leg. We have a pullback bar here, this tail plus the low of that bar, and it's the end of the second leg, and then we have the third leg up. You can take the short below that bull bar or below that bear bar, or wait until you see 3 or 4 consecutive bear bars, and then either sell the close of this bar or sell the close of that bar. At that point, the probability of making a profit is greater. If you take this later short, your stop is still up here, and you're expecting at least a small second leg down. This represents the market flipping to always in short. The bulls are giving up. They understand that this is a bull trap and that the market is probably going to trade down. In this particular case, we had a parabolic wedge top, and we have a first leg down, a pullback, a second leg down, and then a bull bar, a pause, and then a third leg down. A parabolic wedge bottom at the bottom of a trading range with a good-looking bull bar. You can see parabolic, if I connected the low of the first push and the second push, I get one line, and then if I connect the low of the second push and the third push, I have an even steeper line, and therefore it's a parabolic curve accelerating downward. It's a failed breakout below the bottom of a buy climax, a bull leg, and it's also a failed breakout below the bottom of a bull trend. In this particular case, it formed a perfect double bottom with an earlier low, the bottom of the trading range. And you have a very strong buy signal bar. Even though the channel is very, very tight and you think the reversal up might be minor, this is a reasonably good probability trade for at least a couple legs up. 1 pullback, 2 or 2. We have a parabolic wedge here, a first push up, and then a tail. You can say we went up, down, end of the first leg. And then we have another pair of consecutive bull bars with a small tail on top, end of the second leg, and then a pullback to that close and that low, and then a third push up. For me, this is a parabolic spike and channel bull trend. It's a parabolic wedge. First push up is the spike, and then a pullback, and then a couple more pushes up. This bull bar, and then a small bull bar, pause, and then a bigger bull bar again. On a smaller time frame chart, you could see that this is a pullback here, and this as well, from that high to this low. But you don't have to look at the chart. You can infer it by simply looking at this chart. We have a pause and then a bull bar. 2 bull bars, a pause, and then a bull bar closing near its high. 3 consecutive bear bars closing on their lows. The market probably is in the process of reversing from a parabolic buy climax. Look at bar 3 right here. Bulls are buying for any reason. They're buying closes. They're disappointed by this bear bar, and they decide maybe it's a parabolic wedge top, maybe I should get out break even. They place limit orders to get out at break even at that close. And look what happened here. It got right to their entry at that close, and their limit orders did not get filled. The market turned down. The bulls started giving up, and then they continued to give up here. These 3 consecutive bear bars represent the bulls giving up. It's a give up series of bars, and the bears are doing the opposite. They know this is a potential parabolic buy climax. They know the bulls are disappointed by this bear bar, and the bears start to short with a limit order just below that close, believing that the bulls will try to get out at that close. When the market gets near that close, the bears start to short with limit orders or at the market, and they turn the market down. After the second or third bear close, bears start selling closes. It becomes a sell the close bear trend, and the bulls are giving up. No one left to buy. We have a series of bear bars, a pause, a series of bear bars, and then a small bull doji, a pause, and then another sell climax here. You have three pushes down, 1, 2, 3. Parabolic wedge bottom, which is a sell climax, and it led simply to a trading range instead of a reversal. Very common when you have a sell climax or a buy climax for the market to go sideways instead of reversing. This is a very common pattern. Very strong breakout, second push, third push, or third push. We can call it a nested parabolic wedge, 1, 2, 3, and the third push divides into a wedge, 1, 2, 3. In any case, spike, pullback, parabolic channel, and then you get a pullback, 5 bars or 10 bars. It's still a bull flag at this point. 20 bars, probably still a bull flag. Maybe 25 bars, it still looks like a bull flag. The bulls are trying to buy, they're trying to buy again. But once you get this, a pair of consecutive bear bars closing on their lows, decent sized bodies, the bulls are giving up, the bears are taking control. It's probably going to be a measuring gap for a measured move down. You have a pullback that's endless. It just keeps going on for 10 bars, 20 bars, 30 bars. And that often is the start of a bear trend, especially after a parabolic buy climax. And if you start to see it pulling back in a tight trading range that slopes slightly downward, after 5 or 10 bars, you have to be thinking that this could be an endless pullback that will convert into a bear trend. You can wait. There's no good buy. However, once you see the breakout, it's a good sell. Some bears will sell here, below that bar. Others will say, okay, you get disappointed bulls here. They'll probably try to get out break even if they bought that close. So there'll be some sellers at that close. You can see that tail on the top of this bull bar. And then another bar with a tail on top. It looks like the bulls are giving up. More bulls will sell below that bar, and bears will sell as well, taking a chance that the buy the close bulls are giving up, and they'll wait 5 or 10 bars to buy again. And it never got back to that price again. No consecutive big bear trend bars, but 13 bars in a bear microchannel. No pullbacks for 13 bars. Possible endless pullback. And when you see an endless pullback, there's a 50-50 chance you're going to get a bear breakout and a swing down. The bulls are trying to reverse, 2 legs down, 1, pullback, 2. But where is the follow-through buying? No follow-through buying. That means this might instead be a double top bear flag. A double top with this bull bar, slightly lower low. We have another tight trading range, and then we get the bear breakout. Bear breakout and follow through, it's now always in short. All through here, it's always in long. The probability favors trend resumption up. But with each bar that gets added, it becomes more and more neutral. After about 20 bars, it's almost 50-50, maybe slightly higher probability for the bulls. But once you get the bear breakout and follow through with a pair of decent sized bear bars compared to the bars to the left, the market becomes always in short, and you're going to get probably a measured move down. From the top here, in the middle of the gap, I could have used the breakout point, which is this low or that low, and we got a measured move down. And what took place at the measured move down? Bears bought. They took partial profits here, very tight bear channel, even though good bull bar. A lot of the bears, if they do get out here, they'll sell again below a bear bar, like maybe below that doji bar for trend resumption down. This did not do enough to reverse it back to always in long. Here we got a gap up on the open, 3 pushes up, first push and then a pullback, second push and a pullback, and a third push. And now we have a bear body. Possibly a parabolic wedge reversal on the open. Is this particularly climactic? Well, not especially. We have two decent bull bars here and here. That means if it's not especially climactic, the bulls may not be exhausted, and instead of reversing into a bear trend, it might be simply a reversal and then a trading range, which is what we got. Without the climactic look to it, without extreme buying, consecutive big bull trend bars closing on their highs, this is more likely going to be a bull leg in a trading range rather than a climactic end of a rally and the start of a bear trend. The bears had a chance here, but you can see once the market got to the prior low, traders bought it. Trading range behavior, new low, reversal up. On the other hand, we have a pair of bear bars here, two big bear bars here, another big bear bar here. This is much more climactic than this was, much more chance that this is going to lead to a reversal, especially with a pretty good looking bull bar. Yes, it's a sell vacuum test of the bottom of the trading range. We have a double bottom, a bear breakout, tried to reverse here, failed, tried to reverse again here. Good looking bull bar, and we got a successful reversal. Couple legs up, one, pull back two. This was simply a sell vacuum test of the bottom of a trading range, and we got a failed breakout below the range. I call this a double bottom, this low and that low, even though they're not at the same level. The market tried to reverse here. This is so strong, probably at least one more leg down. We got one more leg down. Two attempts to reverse here and here, even though not at the same level. It's a type of double bottom. It's also a parabolic wedge. One, pull back, and then second, sell climax, pull back, and then a third final, sell climax. Parabolic wedges are common on the open in the first hour or so. Anytime you see a strong rally with a pause and then a series of buy climaxes on the open, you always have to be thinking about the possibility of a parabolic wedge. Here, it's a possible parabolic wedge top. First push up, pause. Second push up, pause. Third push up, and then even a fourth push up. Is the parabolic wedge 1, 2, 3, or 1, 2, 3, 4? It doesn't matter. It's a series of buy climaxes on the open, and you have to be thinking about a possible parabolic wedge. And as often happens after a parabolic wedge, especially on the open, you get a pullback, and it forms a tight bear channel lasting about 10 bars, and then the market decides whether it's going to resume up or reverse down. Here, we get a big bear breakout, probably at least a measuring gap for at least a couple legs down. One, pullback, two. $13 bars up without a pullback. That alone, a 13-bar bull microchannel alone, is a type of a climax because it's unsustainable, and anything that's unsustainable is a climax. And then we have consecutive buy climaxes, a pair of bull bars, big bull bar closing on its high, a pair of bull bars, this one closing on its high, and then another attempt. Climactic behavior. You can call it a low 4 if you want. We tried to get a low 1, failed, tried to get a low 2, failed. And then we get a breakout, tried to get a low 1, failed, and then try to get a low 2. It's a type of low 4. We have consecutive tops. We tried to get a low 2 top here, instead got a breakout, and then tried to get another low 2 top here, and succeeded. Big bear bar, closing below the lows of the past 20 or 30 bars, far below those lows. The market's always in short for at least a small second leg down. The scale in bulls who were buying all the way down gave up. They were overwhelmed, probably a measuring gap. The bulls tried to reverse here, but look at this high compared to that low. This is simply a breakout test of that low, and it failed, and we got a big second leg down. So leg 1, pull back leg 2. Parabolic wedges need extreme moves as a sign of exhaustion. Without the extreme moves, the traders do not get exhausted and the trend can go a long way. Here, 3 pushes down, 1, 2, 3, very tight channel. If you want, you can call it a parabolic wedge. I would not. Where is the extreme selling? You know, we get a bear bar here, but it's small compared to these bars and this bar. This does not look climactic. It does not look like the bears are worn out. And the result was we have a wedge, but not climactic selling in a very tight bear channel. This is probably going to result in a minor reversal and a bear flag, and then continued lower prices. This is more likely a small pullback bear trend than a climactic wedge bottom. No big bear bars, no extreme selling, no climax. It's not yet overdone, and therefore the trend can go down much further. Again, the pattern is just too small to reverse a big bear trend like this, and the channel is too tight. Probably the best the bulls get is a bounce, and then the bears will get trend resumption down. No buying pressure. Where are the big bull bars in any of this? Minor reversal, do not buy. Do not buy a minor reversal in a tight bear channel. This is the dollar versus the yen, a 5-minute chart. We have a strong bull trend and a very abrupt reversal down. Big bear bar, a pair of bear bars, another big bear bar, 3 big pushes down, climactic, consecutive sell climaxes. You could even say sell climax, sell climax, sell climax, sell climax, sell climax. This is a parabolic wedge bottom, double bottom with this low, could be a spike pullback parabolic channel, and a double bottom with the bottom of the channel. You can also call it simply a parabolic wedge bull flag. It's a parabolic wedge bottom, but it's above the bottom of the bull trend. It's around a 50% pullback, and it's testing the bottom of a channel after a spike up, spike, pullback, parabolic channel. And then we reverse down, testing the bottom of that channel. A very good looking bull bar. It's a reasonable buy. You can see that you can draw a best fit channel, and this is within that channel. Strong bear bars, each one with bad follow-through. A series of sell climaxes, each one with bad follow-through. You have to be thinking that this is unsustainable behavior and probably a bear leg in a trading range or a bear leg and a bull flag, and the market will have at least a small reversal up. Bull bars after every big bear bar. That is not how bear trends look. That is how a bear channel that's about to have a bull breakout looks. Bear channel, bull flag, chances are you're going to get a bull breakout. Again, 50% pullback in a bull trend, probably a parabolic wedge bull flag. Trends always have wedge reversal patterns, and strong trends always have bad looking wedges. Lead to minor reversals, not trend reversals. Very strong bear trend, and if you look at it real time as the bars are unfolding, you'll constantly see wedge bottoms. But when a channel is this tight, a small pullback bear trend, each one of those wedge bottoms will lead to a minor reversal and a bear flag, and the bear trend will continue. There's just no significant buying pressure. A little bull bar here, a little bull bar there. Remember my 80% rule. 80% of reversal attempts in a strong trend will fail, and the trend will continue. 3 pushes down, 1, 2, 3, wedge bull flag. Very tight bear channel. Where are the bull bars? No buying pressure. This is not a tradable bottom. It's going to lead to a bear flag and a resumption of the bear trend. 3 more pushes. We have another wedge. We have tails. We have a bull bar. Is this a good buy? No, it's a very tight bear channel. Any reversal is probably minor. The best the bulls probably can hope for is a small trading range. More likely, there's going to be trend resumption down. We have a gap here, this low, that high. This might in fact be a measuring gap. In fact, it was. Another wedge bottom. Maybe we should buy. Maybe we should buy this. Very tight bear channel, minor reversal, probably bear flag. Another wedge bottom. Certainly this has to reverse at some point. Beginners are constantly seeing wedge bottoms in bear trends. This is a small pullback bear trend. The pullbacks only last a bar or 2 or 3 bars, and they don't go up very far. All of these pullbacks are bear flags. The trend will continue. Do not be too eager to see wedge bottoms in bear trends, especially a small pullback bear trend like this. All of these wedge bottoms will lead to bear flags and the trend will continue. Never look for a reversal when the channel is tight, because a tight channel is a breakout on a higher time frame chart. If this is a 5-minute chart and you look at a 15-minute chart, it'll be simply a series of big bear bars closing on their lows. And you do not want to be buying if every bar is a big bear bar closing on its low. Gaps all the way down, this high, that low, this breakout point, these highs, this low, this high. Gaps all the way down, very strong bear trend. Whenever you see gaps all the way down and the pullbacks lasting only a bar or two and not any consecutive big bull trend bars, don't even think about buying. Anytime you see a buy setup, wait for it to fail and reverse down and then look to sell. Expect trend resumption, expect every reversal to be a bear flag, and constantly look to sell. We're trying to reverse up, sell below a bear bar. Trying to hesitate, maybe base, sell below a bear bar. Sell below the prior bar, sell below the prior bar, sell below the prior bar. Again, 80% rule. If you're in a strong trend, 80% of reversal attempts will fail to reverse the market, and they'll become flags and the trend will continue. Wedge top, 1, 2, 3. But where is the selling pressure? Very strong bull breakout, a 1-bar pullback. A wedge top, but look at the pullback since this low. The pullbacks are just a bar or two and just really tiny. Chances are the best the bears get here is a trading range, not a bear trend. A low probability sell. Another wedge top. This time for sure it has to work. We have a bear bar here. The sell triggered. This went below that low. Another sell that triggered. A third sell that triggered. Certainly one of these reversals has to work. The pullbacks are way too small. Where are the big consecutive bear bars? Where is the evidence that the bears are strong? A sell signal bar alone, even if it's a third push up, is not enough reason to short a strong bear trend. Another wedge top and another sell. Look at all these great sell signal bars here, here, here. Now our fourth one. One of these has to work. Well, eventually one will work, but these are all low probability shorts. A bear signal bar alone is not enough reason to sell a wedge. There has to be some evidence of selling pressure, and when the pullbacks are really small like this and the channel is very tight like this, there's no significant selling pressure, so only look to buy. Every time the bear trend reverses, the bulls have to buy again, for example, above a bull bar. Bear trend reversing, buy above a bull bar. Bear trend reversing, buy above that doji or above this bar or even above this bull bar. Third push up, eventually it was successful, but it's still a low probability trade. Higher probability to wait until we get 3 or 4 consecutive bear bars and then sell. The sell signal bars alone are not reason enough to erase the bad context. It's a small pullback bull trend. Do not look to sell. Very tight channel. I don't have the bottom of the channel drawn, but you can see it's a very tight channel. It's a breakout. It's a bull breakout on a higher time frame chart. You only should be looking to buy. Until there's reasonably good selling pressure, bet that each reversal will become a bull flag, not a trend reversal, and buy above a bull bar after every reversal down. Now, I said most wedges in strong trends fail, and that is true. However, most strong trends end with at least some kind of a wedge. Wedge bottom, these are all meaningless. The bear channel is too tight to be looking for reversals. It's far too early to be trading this. It's a small pullback bear trend. It's a very tight channel. It's a bear breakout on higher time frames. Stop looking for reversals. Instead, look to sell a failed reversal, a bear flag. Whenever you see a bear trend, that lacks consecutive big bear trend bars. This lacks consecutive big bear trend bars. Yet, it's forming gaps. Instead of looking at it as a possible bear leg in a trading range, you have to be thinking that it could be a small pullback bear trend, and it could last a long time. Do not look to buy reversals. Now we're starting to get stairs. We have a big bear breakout, and we broke below this low, but it pulled back above that low. The gaps are closing. We're starting to accumulate some bull bars here, 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 again here, and again here. There's some evidence of buying pressure. We have a wedge bottom, 1, 2, 3. I would consider buying this, betting that it's a spike in channel, bear trend. So spike, second push, third push, and then it will evolve into a trading range. However, it's higher probability to wait to buy a major trend reversal. Strong bull breakout, and the bulls are so strong they were able to create gap bars. 2 bars where the lows are completely above the moving average. There's a gap between the low of these bars and the moving average. That usually leads to the final leg of the bear trend before there's a major trend reversal attempt. Higher probability either to buy here for a scalp. This is probably a minor reversal because it's a tight channel. First reversal up probably will lead to trend resumption down. However, it's a strong enough breakout here, gap bars here. That strong trend resumption down will probably fail around the old low, and the bulls will try to get a major trend reversal. I would not buy above this bar after that big bear bar, but now we have a second entry buy. This is a higher probability buy. Higher low, major trend reversal, micro double bottom, this low and that low. It's a second entry buy, above here, above here. Higher probability to buy after you see a reasonably good breakout, and especially after you see 2 big bull bars closing on their highs. Probably going to get at least a small second leg up here or here. Bull breakout with follow through, a pair of consecutive bull bars. Resistance is always a magnet, just as support is a magnet. If you're reversing up, resistance is therefore a target. Whenever the market gets to some kind of a resistance level, there'll be some profit taking, which means there's often a pullback. If we're talking about resistance in a bull trend, bulls will take partial profits. The bears know that the bulls will take partial profits, and the bears will sell, at least for a scalp. Where's resistance? Well, first of all, the most recent lower high in the bear trend is resistance. And when the market got there, the bears tried to get a double top. The bulls took partial profits, 2 legs up, 1 pullback 2. Minimum goal for a wedge bottom is 10 bars, 2 legs up. We have first leg up, pullback, second leg up. A reasonable area to take profits around that prior high in case we get a double top, a break below the neckline, and fall for a measured move. We have a sell climax here, and tried to get a double top here. Instead, we broke to the upside, possibly a measured move up based upon the height of this double top attempt, and you can see additional profit taking there. You could also draw a measured move up from this low to that high, a measured move up from the bottom of the trading range to the top of the trading range. All of those are possible resistance areas. We have another lower high in the bear trend. It's a major lower high. It led to a new low and a strong bear breakout. So there'll be some profit takers around there as well. A wedge bottom, it's a bear channel. And a bear channel is a bull flag. 75% chance you'll get a bull breakout. Only a 25% chance you'll get a bear breakout and then a swing down for a measured move. A bull breakout does not mean bull trend. It simply means a break above the top of the channel. It could result in a trading range, as it did. But once it enters a trading range, then traders will look for a major trend reversal, which we got. A wedge top, it's a bull channel. A bull channel, a bear flag. 75% chance you'll get a bear breakout, at least into a trading range, possibly into a bear trend. This wedge top is at the prior high, so it could be a consecutive series of buy climaxes testing the top of what could become a trading range. Bull channel, bear flag, only 25% chance of a bull breakout and a swing up, 75% chance the market will break below the bottom of the channel, which simply means breaking below the bull trend line, which it did, and it could simply go sideways and then resume up, but 75% chance you'll break below the bottom of the channel. Bears, we have a double top, we have a wedge top, a lot of trading range price action here, and then we're starting to get consecutive buy climaxes. A second entry short, first is below that bull bar. Now we have a big bear bar and a pause bar. That is a short below that bar. Here we have a double top bear flag, this high, that high, and we have a bear bar closing near its low. It's an okay short, betting that we get a swing down, which we did. Wedge bottom, 75% chance there'll be at least a small bull breakout. Here we got a very strong bull breakout. Wedge bottom, a lot of buying pressure in here, and we have a failed bear breakout reversed up. And now we have a bull bar here, a bull bar here. This is the third attempt to reverse up. You can also say it's the third failed bear breakout attempt. We tried to break to the downside here. We tried again here. We tried again here. The bears are repeatedly trying to go down. The bulls are repeatedly trying to go up. The bears probably eventually give up, which they did. Here's a give up bar. The bears are giving up. Now we have a wedge bottom, 1, 2, 3. 75% chance you'll get a bull breakout, maybe a conversion into a trading range. We have a spike pullback channel, and we have a pullback testing the bottom of the channel. 75% chance we'll go sideways. 25% chance you get a bear breakout below the bottom of the wedge and a two-legged swing down. This is that 25% chance. An attempt at a wedge bottom near support, the first pullback after a strong bull breakout. Instead of reversing up above the bull channel, which it does 75% of the time, we have a successful bear breakout, which we get 25% of the time. Bears could sell the close of that big bear breakout bar, or they could wait for the double top bear flag. The market went up and then down and went up again, so now we have a double top, this high and that high, and we have a good sell signal bar here, a reasonable short there. We have another bear breakout and a pullback. This is a low one short below that bear bar. We have a wedge bull flag and got a bear breakout. You have to be thinking that it might fall for a measured move down, which it did. So this is a reasonable location to take at least partial profits. And you can see some buying here. It's also around the prior low, another reason to take partial profits. This is the S&P Cash Index, a monthly chart. Here's the 1987 crash. We got 3 pushes up, 1 pullback, 2 pullback, 3, and it's subdivided into a nested wedge. But a very tight bull channel. We got the bear breakout, but what followed? We failed a bull breakout here. We got a reversal down here. But the bear breakout failed here. The bears tried again here, they failed. They tried again here, they failed. We're getting a failed bear breakout below a very tight wedge bull channel. At some point, after maybe 3 or 4 bars, you have to decide the bulls have won and that we're going to get some kind of a measured move up, which we did. We have a 13-bar bull microchannel on a monthly chart. That is incredibly strong. It led to a bull trend that lasted 6 years and gained 300 points. A bull breakout above a wedge top. 25% chance you get a successful bull breakout above a wedge top. And this was one of the most successful bull breakouts above a wedge top in the past 50 years. I began by talking about parabolic wedges and how they can lead to reversals. I also talked about how strong trends are constantly forming wedge reversals, but if the channel is tight, those reversal attempts will be minor and become flags, and the trend will continue. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 5 videos on wedges.